Hello and welcome to episode 28 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools that help you identify opportunities, such as our merger arbitrage tool, check out insidearbitrage.com.
On today's podcast, we will discuss the completion of two large M&A transactions that had more twists and turns than a Christopher Nolan movie. The acquisition of a Chinese electric car company that is trading at a negative spread, and outsized CVR attached to the acquisition of Monogram by Zimmer, a flip-flopping insider transaction at a biotech company, Dyne Therapeutics, Elliott's activist involvement in global payments and HPE, and a whole lot more.
Let's get this episode started with a potential deal situation where prominent healthcare entrepreneur Ron Zwanziger approached medical device maker OraSure Technologies with a takeover offer. OraSure is best known for its rapid antigen COVID tests, which, as you remember a few years ago, were highly popular and sought after.
Absolutely. This is actually his second attempt at buying the company, as back in June of this year, Zwanziger proposed paying between $3.50 to $4 per share for OraSure. The details of this new takeover offer have not been disclosed, but OraSure's board had swiftly rejected the initial offer not long after it was sent, without any discussions between the parties. OraSure currently trades at $3.26.
Considering how quickly they declined that offer, you would think the company is doing very well, and nothing could be further from the case. OraSure has seen year-over-year declines in revenue for 7 quarters in a row, and GAAP earnings have been negative for 5 of those quarters. Interestingly, free cash flow was negative only for the last 2 quarters. The stock is down more than 80% over the last 5 years.
There were actually 2 large deals that experienced roller coaster rides that lasted more than 500 days after they were announced, but those 2 large deals finally closed last week. One of those deals took nearly 21 months to complete, and it was the $53 billion acquisition of the energy production and exploration company Hess by Chevron, which was announced in October 2023.
Yeah, this deal had it all. Anything that you can think of went wrong with this deal, but it did successfully close. So to start with, there was political pushback early on with Senate Majority Leader at that time, Chuck Schumer, asking the FTC to investigate whether the deal violated antitrust laws. It's interesting that it wasn't Elizabeth Warren and Bernie Sanders who spoke up. It was Chuck Schumer in this case.
Absolutely. The FTC did go ahead and ask the companies for additional information, which is often known as the second request, which started a regulatory battle that lasted for more than a year through January of this year, and ended in an unusual request from the FTC that the combined company prohibit Hess's CEO, John Hess, from joining the company's board of directors.
John Hess did not take this order lying down and decided to appeal this decision. The FTC did reverse that requirement last week, and Chevron was free to allow John Hess to join the board. The bigger issue, however, was Chevron's rival Exxon, along with China's CNOOC, throwing a monkey wrench into the deal.
One of the primary reasons Chevron was interested in acquiring Hess was its 30% stake in an oil block discovery off the coast of Guyana. This Stabroek oil block covered 6.6 million acres and was estimated to have 11.6 billion barrels of oil.
That's a lot of oil. The operators of this block were Exxon with a 45% stake, Hess with a 30% stake, as you just mentioned, and China's CNOOC with a 25% stake. After Chevron's acquisition of Hess was announced, Exxon announced that based on the agreement it had with Hess and Sinuk, they had right of first refusal to acquire Hess before a third party like Chevron could happily waltz in and offer to buy Hess.
And if all this wasn't enough, the country of Venezuela figured it would muddy the waters even more by trying to lay claim to the offshore oil-rich region. At one point, it moved more than 5,000 soldiers to its eastern coast after Guyana received a warship from the UK.
Imagine that, a warship from the UK to protect its interests. Getting back to that Exxon monkey wrench, the proxy firm ISS, or Institutional Shareholder Services, asked shareholders to abstain from voting for the deal, and Hess's biggest shareholder said that it would hold off on voting for the deal.
To be fair, though, the other proxy advisory giant, Glass Lewis, did recommend voting for the deal, and by May 2024, Hess had received shareholder approval. The arbitration process with Exxon, however, was supposed to start in May 2025.
If we think that some of these lawsuits that we see take a long time, imagine the fact that this arbitration thing was supposed to start almost a year later after they entered into this situation. So instead of just waiting for the arbitration results, Chevron remained on the offensive, and in the first quarter of this year, they acquired nearly 5% of Hess's common stock through open market transactions.
The arbitration case, which was overseen by the Paris-based International Chamber of Commerce, finally came to an end in May, but the results were not released until this month. Chevron and Hess emerged winners and moved swiftly to close the deal last week.
So most of the 6 merger arbitrage related funds that I track and write about each quarter that run concentrated portfolios had a position in this deal. They also had positions in some of the other deals with large spreads that closed recently, including the acquisition of US Steel by Nippon Steel, the acquisition of Juniper Networks by HPE, and the acquisition of Ansys by Synopsys, which was awaiting a final approval from China and closed this week.
Moving on to a newly announced merger, last week, Zeekr, which is a premium electric car company in China, struck a deal to be acquired by the Chinese Geely Automobile for $8 billion. Geely, which already owns 62% roughly of Zeekr, took the company public in the US just over a year ago.
While most consumers in the US may not be familiar with Geely, they have certainly heard of some of their cars. For example, Geely owns Volvo cars, as well as the controlling stake in sports car company Lotus Cars. Furthermore, Geely, along with its founder, Li Shufu, owns 66% of the EV car company Polestar Automotive.
Li Shufu has also independently held a 9.69% stake in Mercedes-Benz Group since 2018, making him one of Mercedes' 3 largest shareholders. I do think it's interesting that it isn't a full 10% stake, because otherwise we'd start to see him file insider purchases or SEC Form 4s.
And there might be other requirements under German law, which might have made him keep his stake below 10%. But it's just fascinating to me that Geely owns stakes in such storied brands and companies like Volvo, Lotus, and a stake in Mercedes. Geely's deal for Zeekr is structured as an all-cash deal worth $2.69 per common share, or $26.87 per American Depository share. Each ADS represents 10 Zeekr common shares, and hence it's 10 times more on the acquisition price.
This deal has been brewing for quite some time, as in May of this year, Geely submitted a non-binding proposal to take Zeekr private by offering $25.66 per ADS. Zeekr stock was last trading at $22.59 per ADS before the offer. So while this newest offer is about 5% higher, this deal overall is trading at a negative spread of 11%. Minority shareholders clearly seem to want to hold out for a higher offer, and it'll be interesting to see if they manage to get Geely to pay more.
Yeah, I've seen several instances where this has happened, but also deals where there was a negative spread and they ended up closing at the original price. Zeekr also owns the brand Link & Company. I was checking out some of the Zeekr and Link & Company cars, and they quite frankly look stunning and are priced at very reasonable prices, especially when you look at the interior of the Zeekr 009 Grand and the Zeekr 7X. The design of both cars, especially from the back, seems to be very much inspired by Porsche.
Well, yeah, you've always been a car person. But
Indeed.
coming back to investing, we'll briefly cover a few other deals that were announced this week. Zimmer Biomet is set to acquire Monogram, which is a medical device company, for $4.04 per share in cash. Monogram common shareholders will also receive a non-tradable contingent value right, or a CVR, which entitles the shareholder to receive up to $12.37 per share of common stock in cash if certain product development, regulatory, and then revenue milestones are achieved through a date in 2030.
This is unusual. We don't often see deals where the CVR is worth 3 times the cash price. So that's interesting to see here. And as a result, what we're seeing is Monogram currently trades at $5.67, well above that cash price. Another interesting deal that we saw this week was Veritex Holdings, a Texas-based bank being acquired by another larger regional bank, Huntington Bank shares, for a closing value of $1.9 billion. This is an all-stock deal where Huntington will issue 1.95 shares for each outstanding share of Veritex.
Continuing on to the spin-off section of this podcast, in February of this year, the medical technology firm Becton Dickinson & Company, which honestly sounds like a lawyer firm, had indicated that they wanted to spin off their biosciences and diagnostic solutions business. Last week, we got some additional details regarding the spin-off.
I'm going to refer to Becton Dickinson as BD going forward, just to make things a little bit easier to say. BD has decided to structure the spin-off as a reverse Morris Trust transaction. This is a kind of transaction where the division that is going to be spun out is merged into an existing company, making it a tax-efficient transaction for shareholders.
An example that we've discussed in the past is where Pfizer took its generics drug division called Upjohn and merged it into the EpiPen maker Mylan to create Viatris. Not only did Pfizer get rid of a low-growth and low-margin division, they also loaded up the combined company with a boatload of debt.
Yeah, I was tracking the Viatris reverse Morris Trust transaction, and when I saw how much debt Pfizer was going to put on that, it was a hard pass for me. Getting back to BD, they are merging their biosciences and diagnostic solutions business with Waters through a tax-efficient reverse Morris Trust transaction valued at approximately $17.5 billion.
After the transaction, Waters will hold a 61% stake in the combined entity, and Becton Dickinson shareholders will also receive shares in this company. Becton Dickinson will also receive a $4 billion cash distribution pre-closing, which will coincide with Water raising $4 billion in new debt, which would imply that the company would have a leverage of 2.3 times EBITDA.
BD currently has over $18 billion in net debt on the balance sheet, which is about 6 times their free cash flow. And so this transaction will help the company deleverage their balance sheet.
Looking at Waters, on the other hand, the company appears to be very well managed, with high gross and net margins, as well as manageable levels of debt, but their key issue is that revenue growth appears to be flatlined.
I can see why they're interested in this transaction, which will water down their shareholders a little bit, despite having to take on higher levels of debt than they had in the past. The transaction is expected to close in Q1 2026. And quite frankly, looking at this whole situation, the thing that jumped out to me the most was Waters looked like an interesting company that I would want to explore further, especially if this transaction is allowed to complete and close as expected.
Absolutely. It is also worth mentioning that the GCI Liberty spinoff from Liberty Broadband has finally completed, and that GCI Liberty started trading this week.
Let's switch gears a little bit to talk about stock buybacks. We saw nearly $1 billion buyback from the automotive and fire protection products company Gentex this week. The business is quite familiar to us due to the fact that they completed the acquisition of Vox in April of this year. Vox specializes in automotive and consumer electronics, offering in-vehicle entertainment, security systems, premium audio products, and biometrics security solutions. In fact, whenever I think of Gentex, I'm actually reminded of their rear view dimming mirrors that are, I think, based on cameras instead of being real actual mirrors.
Exactly. Now, through this merger, Gentex anticipated an annual revenue increase of between $350 million to $400 million. The transaction stood out to us because we frequently ran into Vox when reviewing insider transactions, with its director, Beat Kali, often buying shares of the company. In February 2023, Mr. Kali was appointed president of Vox, but his insider buys dated back to April 2020.
Over time, he accumulated significant holdings, becoming the largest shareholder of Vox International Corporation's Class A common stock as of December 1st, 2022. However, his long streak of buying ended in October 2023 when he sold about $2 million worth of shares to director Stephen Downing.
In fact, for a while, you and I both thought that Kali himself might eventually acquire Vox, but the shift from purchasing to eventually selling shares shifted that perspective, and eventually the Gentex acquisition came through. So we were right about Vox being a prime acquisition target. We were wrong about who the acquirer might be.
Yep.
Gentex as a company is pretty solid. It has net cash on the balance sheet, has strong margins, and isn't valued too richly either.
Yeah, I still remember every night we would see insider transaction by Beat Kali, and we would keep wondering why is he finding this company so fascinating that he keeps buying almost on a daily basis. This buyback represents almost 18% of Gentex's market cap at announcement. So that's just a pretty large buyback in terms of the entire company. Another buyback that stood out was Citigroup, which announced Q2 results and saw its stock jump to, get this, a 17-year high.
Exactly. I mean, it was just 2 episodes ago that we talked about many of the major banks, including JP Morgan and Morgan Stanley, announcing large buybacks. And we actually mentioned Citigroup in the context of them announcing a $20 billion buyback back in January, under which $3.75 billion had been purchased year to date. Now, as part of their quarterly results being announced, the company also noted that they expect to repurchase an additional $4 billion worth of shares during Q3 of this year.
Yeah, I was in New York City last week and happened to meet with C.U. Lee, who writes on Substack, and we've communicated in the past. And during that dinner, Citigroup was one of the companies that he mentioned. And he's probably quite happy to see their stock so high, as well as this continued buybacks from the company. The last buyback we want to mention today is Jabil, which provides manufacturing services and solutions. The company announced a $1 billion buyback, representing 4% of its market cap at announcement. However, Jabil seems to be aggressively announcing these buybacks and actually following through on repurchasing shares.
The company has actually managed to repurchase a whopping 26% of its shares outstanding over the last 4 years, and last announced a $1 billion buyback in just September 2024, so just a couple months ago. So it's interesting to see yet another $1 billion buyback be announced.
And it's good to see that they are buying back stock not just to offset shareholder dilution from stock-based compensation, but they're actually retiring the shares that they are buying back. Switching gears now to insiders, flip-flopping insiders are some of our favorite type of insiders, so much so that we track them as part of a special screen on Inside Arbitrage. While we've talked about flip-floppers multiple times in the past, a quick overview of what a flip-flopper is as follows.
The SEC has a short swing profit rule that aims to disincentivize company insiders from engaging in short-term trading, and thus requires them to give back any profits from conflicting trades that happen within a 6-month period.
The rule is such that if an insider of a public company buys and sells, or on the other hand sells and buys, stock of the company within a 6-month period, they have to disgorge profits from those matching trades back to the company.
Every once in a while, we come across insider transactions where the insider indicates that the transaction actually violates the short swing profit rule, and the insider will return any profits from the prior trade back to the company. Flip-flopping insiders, in some sense, are sending us a signal that they think the prevailing winds have changed, and that they are willing to give up some short-term profits in order to make even more money down the line.
Yeah, we've seen it both ways, right? We've seen the actual footnote of the Form 4 filing tell us that this was a short swing profit rule violation and that the insider knows they have to give money back to the company. On the other hand, we have also seen situations where they don't indicate that in the footnotes, and it's entirely plausible that the insider is not aware of this rule and ends up maybe getting a little slap on the wrist down the road from the SEC saying, hey, you got to give that money back to us. Anyways, talking about this specific flip-flopper insider transaction from last week, we saw the CEO of Dyne Therapeutics, a biotech focused on developing treatments for genetically driven muscle diseases, purchase nearly $1 million worth of the company's stock. This purchase was unique for multiple reasons, starting with the fact that the CEO, John Cox, had just sold shares of Dyne Therapeutics in June.
As expected, in the footnotes of this recent purchase, Mr. Cox noted that he had paid the issuer, and the issuer being Dyne Therapeutics, approximately $29,000 in connection with a violation of the short swing profit rule. That being said, his earlier sales in June were the result of automatically vesting restricted stock units and any tax obligations associated with that, but because they were still an open market sale that had occurred within a 6-month period before he had purchased shares this month, he was still required to give back the profits to the company.
This part actually surprised me a little bit because most companies automatically sell a portion of your restricted stock units when they vest. So it's not like the insider is deciding to sell a part of it. And so I wonder if the SEC would be willing to make a change to exempt this kind of transaction. It'll be worth exploring further to see if this truly counts as a violation.
Absolutely.
Yeah, but the other odd thing about this purchase is that Dyne Therapeutics had just closed a secondary offering of the company's stock earlier this month at a price of $8.25 per share, which was a fair discount to the $9.11 per share Mr. Cox purchased his shares at last week.
We found it peculiar that instead of participating in the secondary offering, which we often see insiders do, Mr. Cox chose to wait a week or so, and then purchase shares on the open market at a higher price. These intricacies surrounding the insider purchase alone were enough to make us take a deeper look at the company, and we were quite fascinated by what we found.
Yeah, Dyne Therapeutics specifically has clinical programs for myotonic dystrophy type 1 and Duchenne muscular dystrophy or DMD. When we saw the list of diseases that Dyne was attempting to treat, we were reminded of Sarepta Therapeutics, another biotech that treats neuromuscular conditions and a company that I had probably invested in, 7 or 8 years ago. In particular, Sarepta has established itself as a leader in DMD treatment with 4 FDA-approved drugs to treat the disease, which is actually quite a devastating disease for parents because children with this disease often don't have a long lifespan.
Absolutely. However, the Sarepta drugs face numerous limitations due to inefficient muscle delivery and the need for frequent high-dose intravenous infusions. Sarepta itself is down 90% in the last year and crashed nearly 36% in a single day last Friday after another death was linked to one of their key DMD therapies, Elliott.
The FDA requested that Sarepta voluntarily stop all shipments of Elvides, which the company refused to do, claiming through their own scientific interpretation there were no new or changed safety signals in the patient population.
Given that Elvides is the only approved gene therapy for individuals suffering from DMD, this opens up a window for Dyne Therapeutics to push forward with their own therapies for the disease, which are currently in phase 1 and 2. However, it's not as if things have been all that easy for Dyne Therapeutics either. The $9.02 that Dyne is currently trading at is a far cry from the highs of over $47 per share that the company's stock hit back in August 2024. And overall, much like Sarepta, Dyne Therapeutics is down 80% in the last year alone.
So a combination of the biotech nuclear winter and then these issues with Sarepta are really weighing down the stock. In September of last year, Dyne Therapeutics entirely replaced many members of its senior leadership team, including bringing in a new chief medical officer, a chief commercial officer, and a chief human resources officer. The company's COO and chief business officer also both stepped down from the position. The company had replaced its CEO back in March 2024, and as is often the case when a new CEO comes in, you tend to see that the entire C-suite gets shaken up.
Sarepta had expected to reap in about $3 billion in revenue this year from Elevidys, a market that Dyne Therapeutics can still penetrate and possibly dominate given the ongoing issues with Elevidys. However, this is very much a situation of playing the long game. Given how long approval, despite it being accelerated to a certain extent, will take for any of Dyne Therapeutics' therapies, especially considering how early many of these candidates are in the drug development process.
Yeah, when you and I were discussing this, I mentioned to you that we are not biotech investors, and especially we are not preclinical or clinical stage biotech investors. So this is so far outside our core competency and very much in our too hard pile. But for somebody who understands the science behind this could potentially be an attractive opportunity to explore.
Absolutely. And the insider purchase itself was fascinating from start to finish. And as we know, insiders are often early. They're thinking about the long run, the next 3 to 5 years. So we might see this play out down the road, but it's very much going to be, as I said, a long game.
Yep. Let's now switch gears to activists. Hewlett Packard Enterprises, or HPE, formed a strategic committee of its board and the appointment of Robert Calderoni as a director effective July 16, 2025. These changes were made in connection with a cooperation agreement that they had with Elliott Investment Management. Clearly, we managed to find a spot for Elliott Investment Management in the podcast after several weeks of not really talking about them.
Yeah, I was going to say, this used to be the Elliott podcast, and we kind of moved away from that because we weren't seeing as much activity. But Elliott is back in a double feature because we also saw them make an investment in Global Payments. This investment comes on the heels of Global Payments' $24.2 billion acquisition of WorldPay, which has faced investor backlash and pushed shares of Global Payments to a 10-year low. However, the exact reason for the investment by Elliott hasn't been disclosed just yet. We'll have to keep an eye out to see if any more details emerge, or if Elliott itself takes it upon themselves to write a letter to the board and enlighten shareholders in general.
If you remember, Elliott wrote a wonderful letter to the board of Honeywell, urging them to consider spinoffs, and it'll be great to see if they do something similar with Global Payments to lay out the case for why they're making this investment in the company. Finally, switching to C-suite transitions, Kenvue, the consumer products company that owns brands like Band-Aid, Tylenol, Listerine, Zyrtec, Neutrogena, and more, has ousted its CEO and appointed an interim in place. Kenvue, which was taken public by Johnson & Johnson in May 2023 and was then spun off a few months later in a split-off transaction.
The transaction was structured as a split-off where shareholders of Johnson & Johnson had the right to exchange their shares for Kenvue shares at a nearly 7% discount to the market price, and we wrote about the arbitrage opportunity on Inside Arbitrage in August 2023.
The departure of Kenvue's CEO came a few months after activist fund Tom's Capital pushed the company to either sell itself or consider selling certain assets. New York-based Tom's owns about 14.4 million shares of Kenvue, but considering how big Kenvue is, it represents less than 1% of the company's market cap, which currently sports an enterprise value of nearly $50 billion.
Last week, Kenvue officially announced that they were looking into strategic alternatives and have retained Center Partners and a McKinsey to advise the board. That being said, I wonder how feasible an acquisition itself might be, considering that Kenvue has an enterprise value of $50 billion. I wonder who might be big enough to acquire them, or if the company will be broken up into pieces.
My bet is the broken up into pieces part, because a $50 billion consumer products company acquisition is going to face a lot of regulatory and political backlash. But let's see. The good thing here is it looks like McKinsey hasn't yet been disrupted by ChatGPT. They still are advising companies. Switching to another C-suite transition, we also saw Dollar General's CFO leave the company. This comes a few months after the business sold their family dollar business segment to two private equity firms for a massive loss. The prior CFO was in a position for 2 years and 10 months, and during that time, the stock's performance was down 46%. And this is despite quite a big rebound in the dollar store companies over the last few weeks.
Yeah, I mean, if you buy a business segment for about $9 billion about a decade ago, and then you sell it for $1 billion to a couple of private equity firms, I can't imagine investors or the board might be too happy. And as is often the case, the CFO is the first one out the door.
Indeed.
Moving on to the last C-suite transition to wrap up this podcast, we saw Dave & Buster's bring in Tarun Lal as the company's new CEO after roughly half a year with an interim CEO. Mr. Lal previously served as the president of KFC, which is part of the massive restaurants conglomerate Yum Brands.
Mr. Lal has been with Yum Brands, the company that owns KFC, Taco Bell, and Pizza Hut, in various capacities and roles since 2000. So this is a pretty significant move. Dave & Buster's is an entertainment company that reminds us a lot of Pinstripes, another entertainment company and eatery combination, which are often called entertainment companies. But the restaurants business of Dave & Buster's has always been the most profitable, so that could be why they're bringing an executive with restaurant-related experience over.
And with that, we will wrap up episode 28 of the Special Situations Report. As always, what we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with friends who might be interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.